Hey everybody, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. Welcome to another video today. This is of course part of a video series that we started a number of months ago, and this video series is designed to complement and add value to the Undervalued Dividend Growth Stock of the Week article series. This is a series of articles that we've been doing that I've been doing with Daily Trade Alert. Wonderful to work with those guys, and they contacted me back in 2014 to start a weekly series whereby every Sunday I publish an article that reveals and discusses a high quality dividend growth stock sourced from David Fish's Dividend Champions, Contenders, and Challengers list. So I take a look at a stock every Sunday and I reveal and discuss a high quality undervalued dividend growth stock that appears to be undervalued at the time of research and the time of publication. And we've been doing the articles for a number of years now, and just recently back in May we started doing a video series that's designed to complement those articles. So welcome to another video. We're going to look at one of the very recent Undervalued Dividend Growth Stock of the Week articles that was published actually just yesterday. Today's November 13th. For me, today's Monday, November 13th. Yesterday, November 12th, we published a Undervalued Dividend Growth Stock of the Week article on AT&T, which is the article we're going to go over. And of course, as I show in every video, if you want to pull up the archive, if you're new to the series, be it the articles or the video series, if you're at dailytradealert.com, you go to the Dividend Growth Investing heading there, and then if you click on the Undervalued Dividend Growth Stock of the Week tab, it'll take you to the archive of all of the articles that I've written since 2014. And I'll just kind of quickly scroll down here so you can see what we're talking about. You see a lot of names pull up: Wells Fargo, VF Corp, Apple, Visa's in there. So a lot of high quality businesses, global businesses generally, and at the time of publication, they're undervalued. Now, if you go back and look at an article from 2015, obviously, you know, the data may not be relevant any longer. But if you look at some of the newer articles, a lot of the stocks in there appear to be pretty compelling long-term investment ideas. So getting into today's video, the article that we're going to be going over in the video today isn't quite yet on the archive because it was just published yesterday. And I'm actually in Chiang Mai, Thailand. That's where I live now. And I'm about 12 hours ahead of the East Coast of the United States. So when I'm filming this, it's actually technically early in the morning Monday. So the guys over at Daily Trade Alert haven't gotten a chance to add that article to the archive. I'm kind of getting ahead of them a little bit, but I'm just really excited to do these videos. And so I'm pumped. It's Monday afternoon here in Chiang Mai, Thailand, and I'm always really excited and honored and humbled to be doing these videos and talking with you viewers. And it's just a real pleasure for me, and I really enjoy it. So getting into the article, of course, every article, as I've talked about in prior videos, starts out with kind of what I call a big idea, or it's basically a buy-in. It's why you readers should be interested in the article. Why are you even reading the article? How does all of this fit into your life? How does it add value to your life? How can it benefit you over the long haul? And so with the AT&T article, I start out the article with life, liberty, and the pursuit of happiness, which is a phrase that, of course, is sourced from the United States Declaration of Independence. They're unalienable rights that have been given to every human being. But I kind of pose an interesting question, which is, however, just how much liberty and happiness do we have in our lives? You know, it wasn't that long ago that I was just a typical American working a typical job, living a typical life, and I kind of refer to it almost as like a bubble. You know, you wake up and, you know, turn off your bubble alarm, get in your bubble car, go to your bubble job, and, you know, do your bubble job and go to your bubble lunch. And it's kind of these just repetitive motions that we do almost without thought. And I think if we step aside from that, or we step back from that and take a look and say, well, if it is life, liberty, and the pursuit of happiness, okay, we have life, we're alive, but how much liberty and happiness do we really have in our lives when we go through these repetitive motions? And maybe if we're working a job we don't like, and we have debt, and when we talk about liberty, the word liberty there, certainly in the United States, we're free citizens, true. But when you think about individual lives, and you get kind of into, you know, looking at it not from a macro perspective, but from a micro perspective, looking at it in terms of your individual life, how much liberty do you have? Well, if you're kind of forced to show up to a job maybe you don't like, and you're forced into a number of positions that don't really make you happy in life, then how much liberty do you have? And that pursuit of happiness, How successful is that? And so I kind of flipped that upside down, and how I did that was I started to pursue financial independence. And when you're financially independent, when you're financially free, to me, that's true freedom, that's true liberty. That's when you start to make decisions irrespective of money. So the work that you do in your life is regardless of how much it pays. You start to make decisions that are truly sourced from within. You know, when you are financially independent, you know true liberty because you are at liberty to make your own decisions, and you're able to go about your life as you so choose, and you are in a position to make choices based on the pursuit of happiness. So liberty and the pursuit of happiness, I think, work really well together. And likewise, when you don't have one, you generally don't have the other either. So when you get that liberty, when you get that financial liberty, not just from a political standpoint, and sure, we're free citizens in the United States of America, but when you have financial liberty, then you're really able to go out and pursue happiness as you see fit. And of course, the pursuit of happiness is a very individualistic and very unique thing that is specific to each individual person. For me, it's living in Chiang Mai, Thailand. It's going to the gym 6 days a week. It's eating cheap, delicious street food. It's taking a long walk, waking up when I want. Things like that make me happy, but what makes you happy might be different. But I can almost guarantee you it's probably not just living that routine American life and just kind of going through the motions. It's probably not it. If you had unlimited money, would you still wake up and do some of the things you do? It's an interesting question to ask. So that's part of what I talk about with the video. And of course, we get into, that's kind of the why, or the buy-in, why you should be reading the article, why this investing strategy makes sense and whatnot. And then we get into a little bit of the how, which is dividend growth investing, how living below your means and investing your excess capital into high quality dividend growth stocks, how can that actually get you from, okay, well, I admit that maybe the situation isn't perfect, but how do I improve on it? So that's what we get into a little later in the article. And of course, if you're at dailytradealert.com, it's the top article on the site and in the archive. It should be there by the time this video is published. When you go to that Undervalued Dividend Growth Stock of the Week archive, the AT&T article should be there, and you can kind of follow along as I'm talking in the video here. So moving on beyond that, we talk a little bit about dividend growth investing as a strategy, and then getting very specific, not just dividend growth investing as a strategy, but actually buying into high quality dividend growth stocks when they're specifically undervalued at the time of purchase, how that benefits the long-term investor. And the benefits are threefold, and it's extremely powerful when you're able to routinely buy high-quality dividend growth stocks when they're priced below their value, priced below their estimated intrinsic value. When you're able to routinely do that and regularly do that over and over and over again over the course of many years, you can really put yourself in an amazing financial position, which is what I consider myself to be in. I didn't start this long ago, guys. I started this whole thing at almost 28 years old. I was turning 28 years old, and I started saving, living pretty frugally, investing my capital in high-quality dividend growth stocks, and I became financially independent at 33 years old. And what I mean by that, what I mean by financial independence, is that the passive income, the passive income I earn, which is mostly funded by the dividends that my portfolio generates for me on my behalf, that passive income pays for my basic expenses in life, like rent, like food, like transportation, like my mobile phone, so on and so forth. So I can basically go about life without really worrying about, like, oh my gosh, how am I going to pay my bills, which is a question that a lot of people have to deal with on a regular basis. And once you're able to eliminate that worry, that concern, that stress, that constant question in your life, you're freed up to pursue happiness and pursue passions that add value to your life, so on and so forth. And getting back to undervaluation, an undervalued dividend growth stock should present a higher yield, greater long-term total return potential, and less risk. Those three benefits are relative to what the same stock would otherwise offer if it were fairly valued or overvalued. So if you're paying fair value, or you're paying more than fair value, all of those dynamics will start to work against you. So for instance, if you pay much more than a stock is worth, aka you're going to pay a much higher price, your yield is going to be lower as a result. The long-term total return potential is going to be probably quite a bit less. And then you're adding on risk because you're paying more than what it's worth, therefore creating a disadvantageous position for yourself as a long-term investor. So when you look at a high-quality dividend growth stock when it's undervalued, that presents a much more compelling long-term investment idea because of those benefits. And I kind of lay out in the article how those benefits work in real time for the investor, how those not only how they work, but how they impact you over the long run, which again can be not only significant, but can be really wonderful. And then later on in the article, we get into how you actually go about valuing a high quality dividend growth stock. I mean, it's one thing to say, it's very easy to say, well, just go out and buy high quality dividend growth stocks and then buy them when they're undervalued. And it's quite another thing to actually go and do that. And first of all, obviously, you would need to know how you go about estimating the intrinsic value of a high quality dividend growth stock. And I link to fellow contributor Dave Van Knapp's valuation guide right here in the article, which is a step-by-step guide. It's actually part of an overarching series of lessons, what he calls dividend growth investing lessons, which themselves are designed to take an investor, be you a novice investor or a more experienced investor. It's designed to take you throughout basically, it's designed to teach someone the dividend growth investing strategy from start to finish, how it works, how to implement it in your real life, how to make it successful for you, so on and so forth. So, and one of his lessons within that overarching series of lessons it focuses on valuation, which I linked to in the article. And of course, every stock that I talk about is sourced, as I noted earlier in the video. They're sourced from David Fish's Dividend Champions, Contenders, and Challengers list, which I link here. And I spoke a couple moments ago about my own portfolio, which generates 5-figure passive dividend income for me, and I link to that right there, so you can look at my own portfolio. And of course, that's also for full disclosure. Whenever I'm writing about these articles, a lot of these stocks that I write about, I personally own, so I'm investing my own hard-earned capital alongside you. And if you're ever concerned about disclosure or whether I'm writing about a stock I also own, you can click on the portfolio. That portfolio is updated once a month, and that generally gives you a pretty good idea as to whether whether I'm being fair and honest. I mean, I'm not going to sit here and talk up a bunch of stocks that I'm not interested in and I don't want to buy. That wouldn't make any sense. I'm not just one of those financial writers out there just going on and on and on about the benefits of all this stuff and then not actually taking those steps myself. So I'm not just talking the talk, I'm walking the walk alongside you guys. So for better or for worse, I have my capital, invested alongside you guys, and I'm investing in these high quality businesses with my own money, which is money that I take pretty seriously. So getting into AT&T, it's a holding company that provides domestic and international communication and entertainment services. AT&T is a company, Ma Bell or whatever. It's a company that historically has provided telephone services and going back throughout its history. When you think about telephone services, that was typically a landline. It was typically phone services over the phone lines overhead that you'll see spread out across America. And while they still provide those services, those are mostly more popular in more rural areas, areas with older populations and whatnot that maybe haven't adapted quite as quickly to mobile communication, or maybe can't afford it, or don't feel like they need it, or what have you. But AT&T today is really more of a mobile communications service provider. They make their bread and butter now on providing mobile voice and data services to millions of people across the country, and they also have some international exposure as well. And so they've changed quite a bit over just the last 10 years. I mean, they've quickly moved into investing a lot of money into their mobile network and getting people signed up with mobile data and voice packages, which of course is really wonderful because these are very expensive packages. Mobile data is not cheap. It's gotten cheaper than it was not too long ago, and same thing for voice and texting and everything else. But still, this is a huge cash cow business, and it operates in my mind like a utility because people are as attached to their mobile phones these days as they are to electricity, as they are to the running water, so on and so forth. So when I think of AT&T, I think of it basically like a utility company, and the stock really looks a lot like a utility company when we start to get into the fundamentals and the yield and everything else. And that all said, AT&T is also rapidly diversifying itself and transforming itself. They closed on an acquisition of DirecTV not too long ago, which I note in the article, and that has turned them away from just a communication provider and more into an entertainment. They're basically trying to become vertically integrated. So they have they already had some content delivery businesses through their Uverse and whatnot, but DirecTV is one of the largest paid TV service providers in the world. So that gives them huge exposure and huge scale in content delivery. And what they're also trying to do right now is they're trying to close on the acquisition of Time Warner, which gives them huge exposure to content production. So they're going to own the delivery side and the production side, which gives them vertical integration across the entertainment platform. And then they have the communication platform on top of that, which operates basically like a utility business. And when you think about Time Warner, they're having some questions and whatnot in terms of how they're going to close that. It's a massive acquisition, so people shouldn't be surprised if there are some setbacks and things like that on closing the acquisition. But Time Warner gives them exposure to a massive content production company. You know, they own, of course, Time Warner is kind of split up between three different businesses, if you will. They've got the HBO business, which is huge in itself. They've got the Time Warner Broadcasting, which includes, you know, brands like CNN and TBS and whatnot, a lot of individual channels. And then they have the Warner Brothers Studio, which of course would give AT&T one of the largest movie studios in the world. I think it's referred to as the Big Six, basically, in the United States, and Time Warner Brothers would be one of those. So that gives AT&T greater breadth and scale into entertainment, and again, it would make them vertically integrated. So, and Time Warner, frankly, is growing a lot faster than AT&T, so it would give them a business that's basically kind of a cash cow in and of itself to add on to the utility side of the business, and give them options across communication and across entertainment, which you know, would be incredible. There'd be really no other company quite like that in the world. So whether that turns out for the best or not remains to be seen, but Time Warner, from what I can see, looks like a pretty smart acquisition for them, because although the mobile communication side of the business, mobile voice and data, and even DirecTV, these are all good businesses, but they're also extremely competitive and saturated. I mean, you know, there's not going to be a lot of growth within mobile voice and data in the United States moving forward. A lot of the customers have already switched over, are already there. So it's kind of almost like a zero-sum game between some of the major providers. So it's attractive in terms of it being an oligopoly. There are only a few major providers of these services in the United States, and people are very attached and almost addicted to those services. So that's wonderful, but not a lot of growth. So that's something to look at, and we'll kind of see how that turns out, or how that looks when we look at the growth of the business. But first, looking at the dividend, and again, when we think about AT&T being kind of a utility-like business, one of the first areas where that kind of shows up, or that idea shows up, is in the yield. The stock at the time when I wrote the article, it was yielding 5.89%, which is definitely a very utility-like yield. In fact, better than pretty much any other utility out there. I mean, if you're talking about, you know, electric utilities, I don't know of any that are providing this kind of monstrous yield where you're getting almost 6%. And it's not common where you're going to find a near 6% yield that's also a growing dividend and a safe dividend. And that's what AT&T offers. You're not just getting that near 6% yield. You're not just getting that big dividend, but you're getting a dividend that's slowly growing, roughly in line with inflation, keeping your purchasing power intact, which is wonderful. And then it's also a very, very safe dividend, which for a dividend this big, you would automatically assume there's a lot of risk involved, which with AT&T honestly doesn't appear to be that way. Sorry about that, guys. I had to pause the video. I lost my internet connection for just a moment there. As I spoke about earlier, I live in Chiang Mai, Thailand, and I live in a pretty nice apartment, a luxury apartment that includes free Wi-Fi, but one of the drawbacks to that is sometimes it kind of pops out for a moment. So free Wi-Fi, wonderful, pops out every once in a while, kind of a drawback. Anyways, I'm back. So we were talking about the big dividend, about AT&T offering a very utility-like dividend, actually a superior dividend than what you would think of as utility. Like a lot of the high-quality, you know, large regulated utilities across the United States, their stocks are offering yields somewhere around 4.5%, maybe a 5% in there, but near 6 is pretty tough. Now that said, I started to compile this information about a week ago, and the article is submitted for publication the Thursday before it goes out, which is that following Sunday. So whenever I have this information, and then, you know, I'm doing a video after the article is published, so there's sometimes like a 2-week lag, or maybe even a 3-week lag between when the article's research is done, when the information's compiled, and then, you know, when the video eventually comes out on said article. So AT&T, what's happened is that the stock has gone up a little bit since I started researching it and since the article was published. So just kind of keep that in mind. So the yield has fallen as a result, and of course that dynamic I spoke about earlier, where when you get an undervalued stock and a lower price, the yield is generally higher. Well, it works in reverse when the price goes up and you start to get closer to fair value, that the yield then falls as a result. So price and yield are inversely correlated. So the yield's a little lower than when I started to research the numbers for the article, but still 5.73% yield. That's getting you way up there. That's certainly superior to what a lot of utilities would offer you right now. And you're probably even going to get better growth with AT&T. There's certainly an opportunity for that, especially if Time Warner comes on board and they get some greater growth there on the entertainment side of the business. So I know that that's 3 times the broader market, which is crazy. I mean, if you're an income-oriented investor, if you're a dividend growth investor who's really trying to build income for, retirement or financial independence, and you need that passive income coming in your way, well, AT&T is one of the best options today to really kind of boost your overall portfolio's yield, because I mean that yield were 3 times the broader market. That's 3 times the income that you would be getting if you were investing in, like, let's say the S&P 500, right? And looking at kind of where that falls within the perspective of looking at AT&T historically, or at least looking at it historically over the last 5 years, the 5-year average yield on AT&T stock we can see right here is only 5.2%. So we were getting a pretty advantageous spread there, which I note in the article right here, almost 70 basis points higher than the stock's own 5-year average yield, which is pretty huge. I mean, a 5.2% yield is pretty attractive. When you get near 6, that is really tough to pass up. And of course, if you guys follow me on social media, I'm open and very forthright with any transactions I make within my portfolio. And I've been noting that I've been buying, quite a bit of AT&T stock recently due to that advantageous spread, which generally gives one an idea, or it gives one kind of a thought that, hey, this might be an undervalued stock when you start to see that. And as we go throughout the article, I'll kind of build that case out as we go, because just looking at yield and saying, oh, the yield's higher than it recently has been, and it must be undervalued, that's not really what you should be doing. That's maybe kind of like an initial indicator that you might have something on your hands there and something to research quite a bit further and do your due diligence and everything else. So really wonderful to get that kind of yield, but in addition to that, you've got a growing dividend. So it's not just, oh, I'm going to get a yield greater than fixed income, greater than the market, boom, I'm set. AT&T is also growing its dividend, and they've been increasing it for 33 consecutive years, which we'll pull up David Fish's Dividend Champions, Contenders, and Challengers list. It's got to reload because I opened it before the video started here. So let me get back to the stock again now that the page is reloading. Should take just a moment here, guys. Yeah, sorry about that. I open all the windows prior to the video starting, so that way things can be a little quicker. But sometimes if I've got multiple tabs open and I haven't opened one of the tabs in a while, it'll just it'll have to reload real quick here. So. But anyways, if we go back to the article for just a moment, so we've got 33 consecutive years of dividend growth with AT&T, which stretches through a lot of different changes within the business model, right? So if you go back 33 years ago, AT&T was that kind of Ma Bell. They were kind of that, massive telecom, basically just a telecom company, and mainly a landline at that, right? And then they've transformed over time, they've adapted to all the changes within their industry. They've moved into mobile data and voice. They've closed down the DirecTV acquisition. They're moving into the entertainment space in a massive way, because I mean, Time Warner was at one point, I think, the largest entertainment conglomerate in the world at one point. So for them to move into things like this, that fast and really kind of scale up, and then still keep paying that monster dividend and growing it along the way is really impressive. Because it's one thing to say, well, we can pay out a growing dividend for 33 consecutive years, which is impressive in its own right. Then also to do that as your industry changes in pretty massive and fairly quick ways makes it even more impressive. So getting to AT&T's numbers here, if is the list loading? Here we go. So we got AT&T right here. So this is David Fish's Dividend Champions, Contenders, and Challengers spreadsheet. And this is where I get the information from when I write these articles. When I'm looking at the dividend metrics, I mean the yield, I'm looking at current yield. So David Fish has a yield at 5.82%. I used the yield as it was when I was doing the research on the stock maybe a week or so ago. So that obviously will change day by day, even throughout the course of a trading day. But you see the 33 consecutive years of dividend growth right here line up with the article. And then you're getting a 10-year dividend growth rate of 3.7% with this stock, which is, if you look at inflation over the last 10 years, I bet that's probably, it's probably a good measure above inflation, which is probably in the very low single digits. And even if it is roughly in line with inflation, I mean, to get a dividend that big and then just keep your purchasing power intact, gosh, I don't know if you can really be terribly unhappy with that. I mean, you know, if you look at a yield of 2 or 3%, you certainly want to be seeing your purchasing power grow. You want to see a growth rate much higher than inflation. But when you're getting kind of a bird in the hand and maybe, you know, without the two in the bush, to just keep that bird the same size 10 or 20 or 30 years down the road, you know, I don't know. I don't think you can really complain too much about that. So we've got a 3.7% 10-year growth rate, but you see it's kind of slowed down. There's been some deceleration because what's happened here is AT&T has been just increasing their dividend by 4 cents a year, a penny a quarter basically, which as the absolute number stays the same, the relative number will decline, right? With every year as that dividend gets bigger, if you're still increasing at the same rate, the growth rate will slow down. And that's what's kind of happened here. So the most recent dividend increase came in at 2%. And if they keep doing that, it'll eventually fall below 2%. But with inflation being so low right now, I mean, again, I don't know if that's something you're really all that worried about. I mean, if you're buying AT&T stock, you know, you're not looking for monstrous growth. You're looking for that big dividend, and you're hoping that your purchasing power is going to roughly stay intact. But you're looking to generate income, or at least you're putting AT&T within a greater portfolio, and AT&T is kind of one of those big hitters. You know, one of those stocks you go up to just, you know, hit an immediate home run to get you some income today, and you know the other stocks are maybe going to kind of round the bases. You know, maybe give you more runs over the long run or something like that. But you know, you want those kind of immediate results. You want that immediate income, and that's what AT&T is giving you, and that's certainly why I own it within my own portfolio, which is also, my own portfolio is also spread out across stocks that provide much more growth potential, like a Visa, like a Nike, and things like that. So, you know, I kind of have that diversified spread out, but AT&T is one of my big hitters in terms of current income for me, which is wonderful. So, and I talked a little bit about that. You're getting that monster dividend. You're getting growth roughly in line with inflation, or perhaps just slightly above it. That's, you know, that's something to be pretty happy about. The one thing that might scare investors, I note right here, is that the payout ratio is 94.2%, which is quite high. And of course, you're just basically looking at the dividend against earnings per share, TTM EPS, trailing 12 months. You've got a current quarterly dividend of 49 cents, which works out to $1.96 a year. You've got TTM EPS at 208. So you've got a payout ratio here of 94.2%. Which I note right here. The thing is with AT&T, as I note in the article, they take a number of adjustments on their GAAP EPS. For a company like this, GAAP EPS is probably not the best way to look at its profit. GAAP EPS is usually a good thing, usually the number you want to look at, but with certain companies, depending on, you know, what they've got going on, sometimes free cash flow, I should restate that technically free cash flow is the only number you should be using. Whenever you look at any business, GAAP EPS can be affected by so many different factors that free cash flow is the real number. That's what kind of cash flow are they actually generate. That the bottom line is any company is ultimately worth the cash you can produce from now to infinity discounted back to today. So that's really just the bottom line. So with usually GAAP EPS is a pretty good proxy for profit, and when you're using the payout ratio, when you're using TTM EPS, as I've noted in prior videos, it's generally a pretty good proxy for FCF, free cash flow, but in this case it's just not. So I noted right here the most recent quarter showed $5.9 billion in free cash flow, and they're paying a $3 billion dividend per quarter. So you can see the dividend's very comfortably covered. And I've got the 2 annual reports pulled up for the prior 10 years so that we can look at 10-year compound annual growth. And I just kind of pulled up for the most recent annual report, I pulled up the cash flow statement, the statement of cash flows. And we can just do the math right here. If you don't want to look at the most recent quarter, which you know, starts to factor in some of the recent acquisitions, including DirecTV, starting to kind of manifest and materialize in the company's results. If we even want to look at the last fiscal year, you can see operating cash flow right here, 39,344, right? You see that, okay? And then we've got, you got to take off CapEx to get FCF, right? So we got 21,516 plus 892. Total CapEx at 22,408, 22 bill, right? So we got free cash flow close to 17 billion, right, guys? And then if we see the dividend, we see the dividend 11.7 billion, which, as I noted, was about 3 billion a quarter. So the dividend is very comfortably covered, very comfortably covered. You got 11.8, we'll round up 11.8 billion against 17 billion in free cash flow. So no problems there with the dividend. It's safe. There should be no concerns about, are they going to cut the dividend? That payout ratio is sky high. if you're really looking at just those basic numbers, then you're really not doing the proper due diligence on a company like this. And that's why we do these articles. That's why I do the video. It's why I show you the numbers and everything else. So we've got a great dividend here. We've got a dividend near 6%. You've got growth at least in line with inflation, perhaps even exceeding it. And as these acquisitions, this DirecTV is fully, built into the business. If Time Warner comes on board, there's certainly a chance there that dividend growth could start to accelerate a little bit, and at least get back to the historical run rate, which would be 10%. Or, I'm sorry, excuse me, about 3% or so a year, maybe 4% or so a year. And if you're able to get a 6%, near 6% yield and growth rate 3 to 4%. That is really, if every stock in my portfolio could give me 6% yield and 3.5–4% dividend growth, man, I'd be a pretty happy camper, and I'd probably start to build out my portfolio with just stocks like that. The thing is, you can't guarantee that. You got to diversify yourself because you just never know. But that said, AT&T is a pretty good spot here financially. There's no concerns about the dividend, and like I said, I think moving forward, as we start to see the numbers, I think we could even see a slight acceleration in dividend growth. At the very least, I think the worst case scenario with AT&T's dividend, at least looking out over the next 5 to 10 years, is really just that continued 4 cent a year increase in the dividend, so a penny a quarter, right? And again, it's not a bad position to be in. I mean, it's certainly not something I complain about. So let's get into the growth rate of the business, which will help us not only determine kind of a base case expectation for dividend growth, but also how, figure out how to value the business, what the stock's worth, get to its intrinsic value, or at least an estimate of that intrinsic value. So the first thing we're going to look at is top line growth. We've got 118 billion to 163 billion. If we pull up the statements here, got to get to the statement of income. Okay, so we got statements of income right here for 10 fiscal years ago. We've got the most recent one, which is 2016. See 2016 and 2007. We've got total operating revenue at just under 119 billion, 118,928, which you see right here, and we've got 163,786 for the most recent fiscal year. Which, let me scroll up because I was on the cash flow statement to show you guys that dividend. And you see here 163,786. So if we do a compound annual growth rate, we're looking at these two numbers. So you've got 118,928, and we've got 163,786, right? And we've got 9 compounding periods because the first year isn't a compounding period, it's a starting point. And we've got a compound annual growth rate of 3.62% for the company's revenue, which is actually really solid. As I've talked about in many, I think every video, when I'm looking at a pretty mature company, which AT&T, is let's pull up the market cap. $210 billion company. It's a mature business, right, guys? So if you can get a mid-single digit, somewhere between 3 and 5%, 4 or 5%, somewhere in that range. If you can get that top line growth from a company like that, that's right about where you want to be, and that's where AT&T came out. Now, that said, the revenue's obviously been impacted by some of those acquisitions, with DirecTV being the biggest recently, and then Time Warner's going to change that quite a bit too. So the number we really want to look at is growth on a per share basis, which is the profit per share, which is earnings per share, EPS. Keeping in mind that, as I just noted a little bit ago, the EPS for this company is impacted by a number of different things. So not a real true look at it. And again, AT&T is not a high growth company. So when we look at these numbers, you might say, oh, maybe not the growth, but again, it's a big dividend. That dividend is well funded. So that's why you're in AT&T. Nonetheless, let's get into the bottom line growth here. If we go back to diluted earnings per share, we see, and as I've talked about in videos before, usually Morningstar, if you don't want to pull up annual reports, which I've got the 2 annual reports here from 2016 and 2007 already pulled up. If you look at the key ratios for Morningstar, they generally line up pretty well here. You can see 118,928, 163,786. Those were the numbers we just pulled up. You see earnings per share, $1.94, $1.94. Diluted earnings per share, 210. 210. So you see those numbers line up there. And we can already see that AT&T, the earnings per share hasn't really gone anywhere over the last 10 years. You see this kind of, you see these numbers here, guys? 335, 66 cents, $1.25, 342, $1.24, 237. They're kind of all over the place. That's what I was just talking about, their earnings per share. If you look at their payout ratio in any one year, like AT&T's their payout ratio here in 2012, 141%. then 125%, now down to 56%, back up to 200%. So if you were looking to buy the stock in 2012 or 2013, and you said, "Whoa, the payout ratio is over 100%, the dividend's going to be cut," you weren't looking at the stock right. You weren't looking at the right numbers, and frankly, you're just missing out on a big dividend payer because you're making an inaccurate assessment there on the company's ability to pay its dividend. So. And again, when we look at these earnings per share numbers, it depends on what year you're looking at, what adjustments are taking. Nonetheless, we're taking a 10-year snapshot at it. So we've got $1.94 and $2.10, which is a compound annual growth rate of 0.88%, so under 1%. So not excellent, but really not that far out of the realm of what I'd expect for AT&T, which is somewhere roughly in line with revenue growth, 3-4%, somewhere in there. Which would support like dividend growth, and that's kind of also why we see a dividend growth start to decelerate. It was somewhere closer to 4%. It's now closer to 2%. The business is really only growing at somewhere around 1% if we just take a look at just flat earnings per share. So you can see some of that kind of show up in the numbers. That said, again, I really think there's room for an acceleration here, and part of that is whenever I write these articles and when I do the videos, I use CFRAs. CFRA is a professional stock analysis firm, formerly S&P Capital IQ, and they have a forecast for the forward-looking growth of a business. And they basically say, over the next 3 years, we think this business will compound its earnings per share over the next 3 years at this rate. And we pull up that report. They've got that number here, 3-year projected earnings per share, compound annual growth rate, 3%. So, and that'd be kind of about what I'd expect for AT&T. And they've kind of built in some of those expectations. Some of the expectations they built into that is the strategic acquisitions, providing better growth for AT&T as they start to fully materialize within the business, as they start to fully integrate some of their platforms and they build these things out. And as the company really transforms itself, it's got to kind of right size itself and figure out what works and what doesn't. I mean, these are massive acquisitions happening here, and it's not just overnight that everything's going to just work smooth and the company's just going to blow it out of the water or something. There's always a number of years where things kind of got to shift and work and fit and everything else, and that's what's happening right now with AT&T. So there is some potential for AT&T to kind of move along a little better than what we've seen over the last 10 years, and CFRA puts that at 3% over the next 3 years, which, if that's where they're at, that's where they're at, and that would probably roughly allow for the company to increase its dividend at a like rate, which again, 6% yield, near 6% yield, near 3% dividend growth. I think that's right about where you want to be with this kind of stock. So getting into some other fundamentals, we look at the balance sheet first, long-term debt to equity ratio and interest coverage ratio. As I've noted in prior videos, the long-term debt to equity ratio isn't a number I really place a lot of importance on, but we do use it in these articles because it is such kind of a bellwether metric, if you will. So we get into the balance sheet here for the most recent fiscal year 2016. We look at long-term debt. We can see here, and as I note in the article, they carry a lot of debt, and the DirecTV acquisition certainly not helping that. And Time Warner, the balance sheet will be even more stressed if and when that acquisition goes through. But nonetheless, looking at things as they sit right now, we've got $113 billion on debt, and that's against really roughly very little cash. You see cash and cash equivalents up here. It's a lot of debt. But of course, we got to look at things not just in absolute terms, but also relative terms. So that's what we're going to do. So we've got 113 billion, 681, right? Almost 114 bill against stockholder equity, 124, 110. Did I not hit the right number there? 113, 681 divided by 124, 110. So you've got a long-term debt to equity ratio, under 1 basically. Which I note in the article here. I rounded that up to 0.92, which it's not great. It's not terrible. There's a lot of debt, no doubt about it. It's not something particularly worrisome, but if they continue down that and they don't really kind of clean the balance sheet up a little bit as time moves on, it's a lot of debt. And as interest rates rise, that will become more concerning as time goes on. That said, the long-term debt to equity ratio, as I noted, don't really place a lot of importance on that. The interest coverage ratio is what I really look at, because that basically tells me, how able a company is in terms of covering its interest expenses. So let's look at that. So the interest coverage ratio is basically taking a look at EBIT against interest expense, right? So we've got, let me look at this, because I looked at this about a week ago. I got to get back through the numbers here, guys, as I'm going through this. interest expense. Yeah, here we go. Interest before income taxes. Sorry, it took me a moment to kind of read these numbers. So we got 19,812. And to get EBIT, we got to obviously add back in interest expense because that's already been taken out of this number. You can see it right here as a negative, right? So we got to add that back in. 4910. So we've got 24, under 25 billion in EBIT, right? And we got to divide that by the interest expense for the interest coverage ratio. So we've got interest coverage ratio of just over 5, which I note in the article right here. Again, that's an okay number. I've talked about this before. Any interest coverage ratio, when that starts to get below 5, I start to get a little concerned. We're right in that range there. So if that acquisition of Time Warner closes, the debt to equity ratio might change a little bit. It might become actually worse than it is right now. The interest coverage ratio is what I'm really going to pay attention to, though, because of course Time Warner is going to be bringing in a lot of money, a lot of profit, right? Of course, at the expense of additional interest expenses because they're funding a lot of the acquisition with debt. So we'll have to kind of see how that number changes, and it's going to be kind of a work in process maybe over the next couple fiscal years. But as it sits right now, not great, not terrible. It operates like a utility, guys, and this balance sheet looks a lot like a lot of utilities out there. So, you know, if you find a utility-like business where you've got a ubiquitous product that people rely on every single day and they're willing to pay a good chunk of change for it, and AT&T is willing to send you a good chunk of that change over directly to you in the form of that growing dividend, then AT&T makes sense. But if you're looking for a huge growth opportunity in a spotless balance sheet, this isn't the stock for you. Getting into profitability, I basically just take a look at the Morningstar numbers and kind of average them out over 5 years. We look at return on equity and net margin, with net margin being the far more important number in my opinion. So looking at that net margin, we've got net margin here, and you've got the fiscal years right here. So we're basically going back 5 fiscal years, right? So we got 7.9, 9.09, 4.7, 14.17, and you see these numbers all over the place because of what I was talking about earlier with the GAAP EPS being kind of crazy. Divided by 5, so we got 8.32, which I note right here, and then the return on equity too. You see return on equity down here, 10.56, 12.77, 7.02, 19.91, and 7.34. I'm not doing the numbers myself. These are generally pretty accurate. I don't think we need to get down to the penny here on some of these numbers, but this gives us a rough idea of profitability, and it averages out. And it averages out even considering the numbers are kind of a little wick-wack because of the way AT&T reports its numbers and everything. But you know, if we smooth them out, average them out, that should give us a pretty good idea where the business is at. And these are pretty solid numbers for what's essentially kind of a commodity-like business, a utility-like business, a competitive business, a saturated market. These are really pretty good numbers, and they should only really improve if AT&T is able to really find synergy within the way they start to close these acquisitions, start to become vertically integrated, not just across entertainment, but entertainment and communication. And as they start to kind of work that business in within itself and kind of really figure out what they can take advantage of, then these numbers should stay strong and possibly even improve. And I basically just kind of noting here what we got going on with the business. There's pros and cons. But I think the way the stock has performed, the market and investors have been looking at the drawbacks more than the benefits here of this stock, which, as I note here, the stock has dropped almost 16% over the last month, or at least when I started to do the research on the numbers, and it's trading for 2015 prices. And if we go back and we took a look at AT&T's chart here, we see it at 30, well, it was around 33 bucks when I was writing the article. Actually, we could even say the stock is trading at 2013 prices. You see here? 34.01. It's within a couple pennies of where it's at. I mean, you're basically able to take a time machine and say, well, I want to go back and buy AT&T in 2012. You know, I wanted it in 2012. Well, you can do that. You can do that right now because it's trading at the same price. And frankly, in my opinion, it's a better business. It's certainly more diversified, and it's becoming more diversified. And as that market starts to saturate itself and the growth opportunities limit itself, AT&T is branching out. I mean, your alternative is to say, well, they shouldn't do this. They should just stay a mobile phone company and just continue to try to play that zero-sum game and fight tooth and nail with their competitors and get into a pricing war with their competitors. And I mean, that's not really where you want to see AT&T, at least not in my opinion. So they are doing good things here, and frankly, you're able to go back to 2013, probably even further if we go back further. You're able to take a time machine here and buy the stock for the same price it was back then, and what's really a better business, and really probably a similar valuation, because we see that the company hasn't grown that much, but I think with better prospects today than it had back in 2013 all in all. And we see the PE ratio here at 16.45. If we compare that over the last 5 years, we start to look at some of the valuation metrics as we start to build our valuation case here. We can see that, looking at its recent historical average, the stock is a little cheaper. And this 5-year average of 27, it's not really a number that I think we can place a lot of value on or a lot of importance on. Right here I notice that I say that compares very favorably to both the broader market and the stocks on 5-year average PE ratio of 27, but the latter metric shouldn't really be considered due to numerous adjustments. I've been talking about that all video long. That said, if you want to look at price to book, the 5-year average right here. If you want to look at sales, we're paying less for revenue than we have been over the last 5 years. If we look at cash flow, you're paying less for cash flow, and the yield is also higher as a result. So across the board, investors are basically paying less for AT&T than they have been over the last 3 to 5 years, which is wonderful considering where it's at relative to where it was over the last 3 to 5 years. And then we get into the dividend discount model analysis, which I'm going to model out for us right now. We've got that dividend at what, $1.96 a year, right? Yeah. We got the dividend at $1.96 a year. And what I use for the dividend growth, I've got the dividend growth rate of 3%, which is a little lower than the 10-year dividend growth rate, a little higher than the recent dividend growth rate, also factoring in the CFRA projection for forward-looking earnings per share growth moving forward. And this kind of does factor in that Time Warner acquisition. So if they don't close Time Warner, the balance sheet won't suffer as much, but I think the growth potential is a little lower. So could they come in lower than this? They could, but then I think, if you say, well, it's only going to gross dividend at 2.5% or something like that, then you're getting pretty close to a fairly valued stock, still yielding you a monstrous dividend, a safe dividend, a growing dividend, better than really almost what you're going to get almost anywhere else in the market. So your downside with this idea here, I think, is pretty limited relative to the upside, especially in terms of aggregate income over the long run. So I've got a dividend growth rate of 3% modeled in here. Over the long haul, I don't have a 2-stage because there's not going to be a lot of change, I think, in growth. And I've got an 8% discount rate I've talked about in prior videos. The discount rate I generally use would be 10%, but I lower that for higher yielding stocks because all else equal, a stock paying me much more income today is worth more to me as an income-oriented investor than a stock paying me much less income. So all else equal, I would prefer a stock yielding me 6% over a stock yielding me 2%. That's just more income in my pocket, which allows me to reinvest at a greater rate or pay my expenses with a much higher degree of certainty, so on and so forth. So that's where we're at with the dividend discount model analysis. We've got a fair value of 40.38 on the stock, which I note right here. And then I talked a little bit about why the dividend discount model analysis is used, which is really just a tailored version of the discount cash flow model analysis, which is, from what I understand, in my opinion, is the kind of gold standard of valuing stocks in general, not just dividend growth stocks, but any stock. The dividend discount model analysis is just tailored for dividend growth stocks, making it a little easier to get your bottom line number. And then, of course, with every article, I compare my analysis, my valuation, to what professional stock analysts come up with. I use Morningstar and CFRA. And if we look at their reports, we've got Morningstar. They got their fair value estimate of $40 on a 4-star stock, with 3 stars being what they consider a fair value. 5-star stock would mean a stock that's vastly undervalued. 4 stars in between those two, a moderately undervalued stock. They have it at $40. I note it right here, $40, 4-star stock. And if we get into CFRA, they've got it as a 4-star buy. And they've got their fair value at $34.51. And it looks like it's come up actually. When I wrote this CFRA, if you watch my videos, you'll see that I'll put a number together, I'll put this information together, and like 3 days later, the number will change. I don't know why they change their numbers all the time like that. I really can't answer that. Maybe they can answer that, or maybe they see this video and email me. But I mean, obviously this changed in less than a week. And let's see if they have any kind of date on that, like a date stamp. Yeah, they have November 10th right here, guys, right? So just 3 days ago they changed the number compared to where it was a week ago. So it went higher. And actually, if we want to really look at things here, they have a 12-month target price on the stock of $41, which is right in line with Morningstar's fair value and my fair value. So when I'm using the numbers, though, when I'm averaging them in, I'm using their fair value calculation, which is actually lower. So when I come up with my bottom line, when I average these numbers out, it's actually more conservative than what I think it really is. So if anything, this is a pretty conservative look at the stock's value. So I'm just averaging these 2 numbers out, 40.38, 40, 33.93, which comes out to 38.10, which if we did it again today, it'd be a little higher due to that slight change in CFRA's number. Not going to be a lot different. And when I wrote the article, I had it to 14% undervalued. It'd be a little less today because in the last few days, the stock has kind of bounced up a little bit. Again, not much, just a little bit. But again, I think if we were to use that 12-month target price here and say all three numbers are close to 40, then obviously this fair value would jump up quite a bit, closer to about $40, and the stock would look even better than it does. Which, as it sits, if you're going to tell me, hey Jason, you can buy stock with a yield near 6%, you're going to get dividend growth roughly in line with inflation or slightly higher, and you're looking at potential of double-digit upside on top of that, where do I sign up? I don't know what more you want, really, when you look at the opportunities in today's market, which are relatively limited. And then we get in the bottom line. It's a high-quality business with tremendous record of paying shareholders a huge and growing dividend. Their ability to continue doing that could very well improve moving forward, yet the stock's recent price action apparently discounts much of this. Short-term volatility is often a long-term opportunity, in my opinion, and the stock has a potential for 14% upside on top of a market-crushing yield of almost 6%. If you like your dividends big and you want them to get bigger every year, which who doesn't, am I right? This dividend growth stock should be on your radar. And that's where we're at with it, guys. That's kind of the bottom line for this. I think it's a utility-like stock that provides better than utility metrics in a number of ways, especially on the yield side. And potentially on the upside too, because there aren't a lot of utility stocks that are undervalued quite like this. So that's it for today, guys. I hope you enjoyed the video. It's always a pleasure for me to do these videos. I love talking this stuff. I could talk this stuff all day. I love doing these videos. It's an honor of mine. It's a true pleasure. Hope you enjoyed. This will probably be up in a few days. So if you enjoyed, please leave a comment. Please send us an email. Any feedback, be it critical or positive, one way or another, we appreciate. Hope you enjoyed. Hope it provided some value perspective to the article. Hope it provided value to you. And we'll see you again very soon. Appreciate it. Bye-bye, guys.